What if one dividend ETF decision today could shape the income your portfolio produces for the next 20 years? Not just a few extra dollars in distributions, but the difference between modest cash flow and a true compounding income engine. Most investors chase yield. They see 7%, 8%, sometimes more, and assume higher income means a better investment. But in dividend investing, that assumption can be dangerous because the real wealth is not created by yield alone. It comes from dividend growth, free cash flow strength, valuation discipline, and the efficiency of compounding over time. That is why three ETFs dominate this debate: SCHD, VIG, and JEPI. One is built around quality dividend growth, one focuses on consistency and long-term dividend discipline, and one offers high current income through a covered call strategy. But only one may be the stronger long-term compounding machine. In this video, we will break them down using the metrics serious income investors actually watch: dividend yield, 5-year dividend growth, payout durability, expense ratio, and future yield on cost potential. By the end, you will see which ETF may be best suited for long-term wealth accumulation, and which one could become a dividend trap when investors misunderstand what they actually own. Let's begin with SCHD. The SCHD. Among dividend growth investors, SCHD has developed something close to a cult following. And the reason is simple. Its strategy is built around financial durability, not maximum yield. SCHD focuses on U.S. companies with strong free cash flow, healthy balance sheets, consistent dividend histories, and sustainable payout structures. The methodology favors profitability over chasing the highest distribution available. That distinction matters more than most investors realize. Current metrics remain highly competitive. Ticker, SCHD, dividend yield, approximately 3.5%. 5-year dividend, CAGR, roughly 11%. Expense ratio, just 0.06%. And importantly, the payout profile remains relatively conservative because the underlying companies generate substantial cash flow coverage. The portfolio includes many businesses associated with economic durability. Companies like the Coca-Cola Company, PepsiCo, Texas Instruments, and the Home Depot. What makes SCHD especially powerful is the balance between current income and future income growth. That balance is critical because a portfolio yielding 3.5% today, while growing dividends at double-digit rates, can eventually outperform a much higher yield portfolio whose distributions barely grow at all. This is where compounding changes everything. And over long holding periods, that effect becomes massive. SCHD also benefits from broad sector diversification, while maintaining strict quality filters that eliminate many financially weaker companies. Historically, that combination has created a strong balance between income generation, dividend growth, and long-term capital appreciation. For investors still in the accumulation phase, SCHD may represent one of the most efficient dividend compounding vehicles available in the ETF market today. Now let's examine VIG. The VIG. VIG approaches dividend investing very differently from SCHD. Instead of prioritizing yield, VIG focuses on companies with long histories of increasing dividends consistently over time. In many ways, the ETF behaves like a portfolio of future dividend aristocrats and, potentially, future dividend kings. The strategy emphasizes stability, discipline, and long-term earnings durability. Current metrics reflect that philosophy. Ticker, VIG. Dividend yield, approximately 1.8%. 5-year dividend CAGR, around 8%. Expense ratio, 0.05%. And the payout structure remains extremely conservative. At first glance, many income investors immediately dismiss VIG because lower payout ratios often allow companies to reinvest more aggressively into expansion, innovation, research, and future earnings growth. Over long periods, that can produce stronger total returns and potentially much larger future dividend streams. VIG also carries greater exposure to sectors like technology and healthcare. Historically, those sectors have delivered stronger capital appreciation during certain economic cycles. That creates a very different investor profile from SCHD. VIG is not designed to maximize current passive income. It is designed to build a future income stream that compounds steadily over decades. For younger investors especially, VIG can behave almost like a bridge between growth investing and dividend growth investing. The trade-off is clear: lower income today in exchange for potentially greater wealth creation tomorrow. And when investors model 20-year compounding scenarios, that distinction becomes extremely important. And now we arrive at JEPI. The JEPI. JEPI became one of the most talked about income ETFs in the market for one simple reason: the yield looks incredibly attractive. Monthly distributions, high cash flow, and income levels that immediately capture investor attention. Current metrics explain the appeal. Ticker, JEPI, dividend yield, often between 7% and 9%, expense ratio 0.35%. But unlike SCHD or VIG, the distribution growth rate is far less predictable. And that brings us to the critical distinction many investors misunderstand. JEPI is not a traditional dividend growth ETF. Its strategy depends heavily on covered calls and equity-linked notes, which means a meaningful portion of the income comes from option premium generation, not from steadily rising corporate dividends. That structure creates both strengths and limitations. During volatile markets or long sideways trading periods, JEPI can generate extremely attractive cash flow. For retirees or investors prioritizing immediate portfolio income, that can be very appealing. But every strategy comes with a cost. Covered call structures naturally limit upside participation during strong bull markets. And over very long time horizons, capping upside can significantly weaken compounding power. That is the core trade-off. JEPI may optimize for present-day income, while SCHD and VIG may optimize for future income growth through uninterrupted capital appreciation and rising dividend streams. In other words, JEPI can produce more cash flow today, but over decades, the slower growth profile may reduce total wealth accumulation. And for long-term investors, that distinction becomes enormous. Now let's project forward and imagine investing $100,000 into each ETF and reinvesting every distribution for the next 20 years. At first, the differences may not appear dramatic, but over long periods, compounding changes everything. If SCHD maintains dividend growth rates near historical averages, yield on cost could rise substantially over time. A 3.5% yield today can become something entirely different after 2 decades of aggressive dividend expansion. That is where the compounding engine becomes extremely powerful. Especially when dividend growth remains elevated year after year, VIG introduces another dynamic. Because of its greater exposure to long-duration growth-oriented companies, VIG may produce stronger capital appreciation in certain market environments, which can accelerate long-term portfolio growth, even with a lower starting yield. Then there is JEPI. JEPI may generate significantly more cash flow during the early years. The monthly income can look extremely attractive, but over longer horizons, the capped upside from covered call exposure may slow overall portfolio expansion. And this creates the real philosophical divide between these strategies. Do you want maximum income today? Or maximum income 20 years from now? Because those are often very different objectives. For long-term investors pursuing financial independence, dividend growth rate frequently matters more than starting yield alone. And historically, the compounding has rewarded patience far more aggressively than short-term income optimization. Now for the risks. Because no dividend ETF is perfect, even the strongest income strategies come with vulnerabilities. SCHD can struggle during periods where growth stocks heavily outperform value-oriented sectors. Its exposure to financials, industrials, and mature cash flow businesses can introduce cyclical volatility, especially during momentum-driven bull markets. VIG carries a different weakness. The immediate income generation remains relatively low. And for investors expecting aggressive passive income early in retirement, that lower starting yield may feel disappointing. But the largest misunderstanding in this entire discussion may belong to JEPI. Many investors see the high yield and immediately assume superior long-term performance, but yield alone can be misleading. Because covered call strategies can materially reduce upside participation during extended bull markets. And over decades, that limitation can significantly weaken total return potential, which means investors chasing headline yield may unintentionally sacrifice future compounding power. There is another risk investors often ignore: valuation compression. When dividend ETFs become extremely popular, investors can overpay for defensive income assets. And even exceptional companies can produce mediocre long-term returns when purchased at inflated valuations. That is why valuation discipline always matters, even inside diversified ETFs. Sophisticated income investors understand something critical: yield should never be analyzed in isolation. The real drivers of elite dividend investing performance remain free cash flow quality, earnings durability, payout sustainability, and long-term compounding efficiency. So, which dividend ETF wins long-term? The answer depends entirely on what the investor is optimizing for. For immediate income generation, JEPI may remain one of the strongest cash flow vehicles available today. The monthly distributions are substantial, and for income-focused retirees, that consistency can be highly attractive. But for balanced dividend growth, long-term income expansion, and compounding efficiency, SCHD may offer the most compelling overall combination: strong dividend growth, quality businesses, low fees, and a structure designed for long-term accumulation. Then there is VIG, the quiet compounding machine. For investors prioritizing total return, future dividend expansion, and multi-decade wealth creation, VIG may ultimately become the strongest long-term performer of all. And that leads to the most important conclusion: the best ETF depends on the stage of the investing journey. Accumulation-focused investors often benefit most from aggressive compounding. Retirement-focused investors may prioritize immediate income stability instead. And sophisticated portfolios often combine multiple strategies together. Now we want to hear from you. If you could only hold one dividend ETF for the next 20 years, would you choose SCHD, VIG, or JEPI? Leave your answer in the comments below. And if you enjoy institutional-level analysis focused on dividend growth, passive income durability, and long-term wealth creation, subscribe to The Yield Strategic. This content is provided for informational and educational purposes only. It should not be considered financial advice. Investors should conduct independent research and consult a qualified financial professional before making investment decisions.